Have you ever clicked sell on a stock and nothing happened? And then you started panicking, thinking that maybe your money is gone. I got you. Hi, it's Chisom. Today we're going to be talking about liquidity. Liquidity is the heartbeat of the stock market. It tells you how quickly or easily you can buy or sell a stock. The more buyers and sellers a stock has, the more liquid it is. The less buyers and sellers a stock has, the less liquid it is. Which means if a stock has people buying and selling it every day, then you can easily buy and sell. But if it doesn't really have people trading on it every single day, then you might have a liquidity problem. To fully understand liquidity, you must first remember bid, ask, and spread. We did that in the previous video. Go and watch it. Liquidity basically determines the spread of a stock. It determines how wide or narrow or tight a spread is. Highly liquid stocks have small spreads, which means that buyers and sellers are almost in close agreement, or even they're in agreement, while less liquid stocks have wider spreads, which means that buyers and sellers, they cannot even negotiate because the spread is too much. The gap for what they're asking and bidding is too much. So that stock will not be as liquid as you want it to be. On the NGX, liquidity varies. For highly liquid stocks, you can see Zenith Bank, GT Co, etc. Trades happen instantly. If you want to buy Zenith Bank right now, you're going to get it right now, because there are people buying and selling constantly on the market. Then there's medium liquidity. That would be the NCR, Beta Glass, and so on and so forth. There are others might take time, or there might be partial fills. I'll be explaining that in a different video. The others might take time, a bit of time, or your order might not be complete. Like you might get it, but you might not get everything you wanted. And then there's the low liquidity stocks. Those are for smaller, less active companies. The orders can sit for hours, even days, even weeks before it's fulfilled, because there's not a lot of people buying and selling it on the market. Or it doesn't mean it's a bad stock. It could also mean that people are holding. Nobody wants to sell. They want to hold long term. So everybody's just holding their stock. They don't want to sell. That can be another reason for a liquidity problem in a stock. When you understand liquidity, it can help you plan your trades, and you also set realistic expectations and avoid panic, so that if you want to buy a stock and you understand the liquidity issues this stock has, maybe it has or it doesn't have, maybe it's highly liquid or it's not liquid, you will know what to expect. If it's a highly liquid stock, you know that your order will go through immediately. But if it's a medium liquid or low liquid stock, you don't have to be expecting that it will execute instantly, because the liquidity issue it's having, you would have understood by then. So if you understand liquidity, it will actually help you with your trades in the market going forward. So next time your order is not immediately executed as you want it to, don't panic. Check the liquidity first. And another way to understand liquidity issue is by looking at the order book. Like I explained before, look at the order book. Is the spread so wide that people are not, these buyers and sellers might never meet in the market? Like their ask and bid is too wide apart. If it's too wide apart, then there might be a liquidity issue there happening there. But if you check and maybe buyers are offering 1.5, sellers are offering 1.510, it's not that bad. It's not that wide. Do you understand? But if you go and see that buyers are offering 1.5, sellers are saying is 2,000, the gap is so much that it's very possible that that stock might have a liquidity issue, so that you will not panic next time. Master liquidity. It will help you master your expectations in the stock market. Okay? And as always, follow me, like, share to your friends who you think might need this, and I'll be seeing you in the next video. Bye-bye.